it's a massive correlation. Credit up, down. Significant macroeconomic correlation with the 0.8 is pretty damn significant. And this is what they've been ignoring for decades since the crisis and all through beforehand. Clearly credit demand, but they can't understand why. And this is again in my little slanging match. He came out at one stage and said, Keynes seems to be saying that creating money equals creating demand. That right in understand. You're going to have your three sectors. And I'm it's the reverse of demand. Actually, moment is where that's what Krugman describes as a patient agent to an impatient agent. Listen to how he describes it. And by the way, their theories for banks lend to one sector, and the sector spends on the other. And I call this endogenous money, and I change the term. That term, I think we'll get the idea across. Now, I'm going to show flow of existing money by with loans signify just the word credit. What it is, what we know it is. We'll see in a moment. I call this a Moore to Basil Moore, who's one of the leading founders of endogenous money theory since the 1970s. I haven't built software, but when I get funding, I'm going to do this. And what this shows is expenditure across the row and income down the columns for each of those sectors. And the rows must sum to zero because I'm showing spending by one sector on the other two, and the sum must necessarily be zero. But the columns can sum to non-zero because your expenditure can be income or vice versa. Now, this gives me an array of numbers, which mathematicians call a matrix. And so the diagonal shows the expenditure and that's negative. And that's expenditure. The total of expenditure is you sum up and take the negative of the diagonal of this matrix. The off diagonal is the income, and they are necessarily equal. So here's the Say's law world. So sector 1 spends A on sector 2 and B on sector 3. Sector 2 sends C on sector 1 and D on sector 3, etc. And if you add up each of those elements, there's expenditure by sector 1, there's the income generated by the expenditure of that sector because expenditure creates income. That's why I call it Say's law in reverse. And that's the income for sector 1. Of course, A, B, and C and D can differ, so that income sum can be non-zero, but the horizontal must be zero. Sector sum of A to F is that money velocity, money multiplied by the velocity of circulation of money. And if I'm a mathematics logic program here just to show that I'm not making any mistakes, I made an arithmetic mistake in a thing I typed in a presentation. Substitute A plus to F with V times N, the velocity of money times the stock of money. It's Milton Friedman. That's that world. What about Krugman's loanable funds? Well, sector 2 is lending to sector 1. The flow of lending goes along the diagonal. Money which was spent by sector 2 is given to sector 1, and then sector 1 spends that on sector 3. And then sector 2 lends to sector 1 because they expect to be paid interest. So there's a flow of interest to sector 2. It has to be based on the interest rate times the level of outstanding loans. If there's a flow which is dollars per year, there must be a stock of loans which is dollars. And you multiply that interest rate to get the interest payments. And then sector 1 spends that on sector 3. So now what I've got, as you can see, is that credit is flowing from sector 2 to sector 1, and then sector 1 is spending that on sector 3. And sector one, because borrow money, they've got an outstanding stock of debt, they've got to pay interest on sector two. So the overall, and all the rows sum to zero, as they must necessarily do. So the credit spending that sector two is credit sector two is spending to sector one reduces as they are spending on one of the other sectors. And more general, but this is, to use the classic mathematical phrase, this works without loss of generality. Okay? It works no matter how complicated the interflows are. C and D might be different from what they were before the credit. It's possible too. I'm just looking at the flow of credit itself. Same exercise, sum up the horizontal and same substitution as I did before. Credit cancels out. We've got velocity plus financial transaction. Deposit interest get actually adding on deposits as well to that, not subtracting. The credit, what that means is if local trends are true, ignore banking and macroeconomics. Per year than sector two does, but it's a trivial change. Now the real world. I'm before but sector one, creating money in the process and in the the asset extended. Now, the same exercise here. Macroeconomic impacts, because credit, whether or not you're talking about asset market, credit is aggregate and aggregating. Conclusion I read after a remarkable more in economics a couple of years ago. Credit does not cancel out. So credit is a part of aggregate demand, and if you leave it out of aggregate, your analysis of aggregate demand, you've left out not the major sum of existing money is large, the most volatile points in the economy coming by surprise. So nor private debt analysis is structurally wrong about a capital economy. That's why they're coming. I know I'm never going to convert a neoclassical on this front, but one way to point out how wrong they are is to take one of their models. They're right if their model is correct, and the structure economy is different. So I took an impatient investment goods and the bank charging intermediation fee. I set a package called Minsky, which is open source, freely downloadable. At some point, actually simulated. There we go. Review the economy, the consumers and the workers model. Over here, where I can find a account, the investment account coming into the account of the credit, the consumer agent going into the account of the interest payment. Workers test. notice in that model, debt doesn't turn up. Why? If the bank's intermediating, the debt is not an asset of the bank. Consumer sector. Over here in the consumer sector. So it doesn't turn up on the bank's books at all. Now, there's operations lending and repayment, shuffle the amount of money in the consumer sector's deposit account across to debt and vice versa. Okay, now I simulate this model, and what I get is an economy that has a growth rate of 0, GDP flatlining at 100, this level of debt, no change in the amount of money. And if I speed up how fast lending, notice the growth actually slow down. And the lending model than the Asia. 100% there. Debt. The level, long-term change in GDP. If they were right about loanable funds bank doing macroeconomics without losing any really important details. And that's what Bernanke was arguing when he didn't bother analysing Fisher's argument to put it. He made his own neoclassical bastardisation of it instead. Now what I can do with Minsky, and that's I designed it as well, it's very hard to model a financial flowchart software that's standard in system dynamics, but it's very easy to edit this in Minsky. So I can say, well look, it's bullshit, the debt is an asset of the consumer sector. So I can just delete that asset, and I can delete the operations, lending, repayment, interest payments, and bank fees. And of course, once I've done that, I've got an asset in the banking sector, but it's still there in the model. It's still there as a liability in the investment sector. So I can come over here and the banking sector, make room for an extra column of assets, say that there's debt, has a liability that hasn't been indicated as an asset when edit this and say interest bank, and let's of a bank fee. There's a couple of changes I should complete correct, but this will do. Having done that, what happens to the model? I treat it with the same initial conditions. See the rise of money stock. GDP is positive. Rate pops up even further. Payment that's got to just increase. Down house repayment. Jump in GDP. Now decision to repay more rapidly and more slowly. An economic slump. All tax. I've changed nothing else in the model. They're exactly identical except saying what the asset of the bank and does lending create and it does not create money. That's what they did to the crisis. That's how it came from. So it's a macro and then the right. Doesn't matter at all. That is absolutely monetary theory and to do that. Forward, bank lending creates money and debt, and the newly created money, and that creates demand, creates assets, and so on. So it's just a simple stylized structure of what's going on is what I've shown you before. And that's all I need. That table alone is enough to model endogenous money and debt. So completeness, but enough to give the entire story. There's debt money, there's borrowers spending and creating demand. to it, and there's so simply shown in one table. That's all you need. Now, what is going to do the models they have? Loanable funds. Well, again, debt's not an asset of the bank. So I can't do it with a single table. I've got to have at least two. One to show the bank being the point through which the transactions occur, and that's what's going on there. There's no debt. So to bring debt in, because debt's an asset of the non-bank sector, I've got to have a table for them as well. So it's a more complicated model. Okay? And this is the thing. They talk about their models being simple. No, they're complicated. Okay? They've got to be complicated to hide the real world from themselves, which they've done very successfully. So the loanable funds means the debt's an asset of the non-banking sector. Sorry, the banking sector. Fractional reserve banking and multiplier, that's another model they think is really good. That on the table, when you show reserve two loans, taken out was cash, negotiable a bank check. It's more complicated. It's an asset. Notes, sure. This model would not be a but which pressure is your deposit using increases can increase well, actually probably better time. Fuels of H2O. Actions of found this divided by population. Anybody want to do private in other words, found macroeconomics. Now, if you differentiate with respect to time of trillions, economic growth, share of output will rise to productivity. Private debt will rise if debt grows faster than GDP. Those are actually definitional statements. Ignoring all the complexity they get into people's behaviour. It's about rationalisation, which means the capacity to prophesise the future. Here, I get a model that's like this, and you'll notice I've got verb. I just to highlight. I could actually expand as well. I'm using full words here to explain the logic. It's exactly hand with those few definitions added in. And accidental thing there. Delete that. wages versus converging, the debt ratio is coming out. Wage notice that ratio, income distribution is going in favour of bankers. Here, on here it's slowly, and you'll have a constant. There will be simulation. Now that's what I think the real world is like. So I'm now going to increase the willingness of capitalists to invest. I start simulating. Show. Watch what happens. They call this great migration, and they're due to exogenous shocks. Finally, unless you have a complex system, once you do it, it pops out incredibly easily. I haven't got dynamics inside there. I get as a much more elaborate dynamics. So this is like financial instability we've experienced 30 to 40 years. Trend happening there, which is very similar. Wages GDP rises, banker share falls, banker share increases. That's the guy. So that's how simple it is to provide a well-founded, indisputable economics, gives us incredible away from academia. And it's strengths where capitalism has weaknesses. This is the and they ignore the strengths that capitalism enticement to society outside original fire and so on. Driven. We should be talking about capitalism. Not only but also the planet has to go. Economics based on apply here and my various colleagues. Universities are time because the same as I've shown you beforehand. If you have the private sector making money, it has to be running a deficit. Okay. Yeah. Factor reduce private debts, allowing you to do both of those. So Germany is an example because it depends upon doing what the rest of the world can't do when it tells the rest of the world to do what it does. MMT when it takes of deficits during boom. Compared to inflation, government should run a deficit. And if you look at the American over 120 years, just for the use they have, average surplus every 2 centuries, strange enough I regard as the long run, is minus 2.4% of GDP. If you take it's minus 2.2%. So the world falls pushes the surplus. Yeah. Pardon? Oh yeah, that's the other thing. I mean, yeah. They don't do the opposite side of things. Yeah. But the rest of you need to talk loud. Okay. It's dollar to become the reserve currency. Keynes's idea was a bankor, which would be an international currency issued in proportion to the size of the GDPs of different countries. Fixed exchange rate was the rule, but if you ran a trade deficit, you'd be forced to devalue. If you ran a trade surplus, not only would you be forced to revalue, you'd also be forced to lend money from your surplus to developing countries. So Keynes saw a potential depressing tendency out of having penalties for deficit countries and not for surpluses. Stop that happening. With still for the American delegation insisting the American dollar became reserve currency, that all got stopped up.
International monetary system. When do you expect a change, and what would be the future international monetary system?
It's actually happening right now because America is helping unite America. Part of that. So Russia, China, and the Arab countries trying to work on a parallel payment system that doesn't use the American basket of currencies that's around. Now, the larger the basket, the more you are like having a national economy. Trump has done a marvelous favour by making it still a country system for international trade. How far we have right now? So I think starting in the next year or two.
Try to control inflation in your Minsky.
Oh yeah, and I get deflation out of it because if you think about what's the normal trend in a capitalist economy, because you have it's rising labour productivity. In fact, it's rising efficiency of machinery, needing less workers, and the real cause analysis. So the 5 slow to rate of change of prices. So what neoclassicals would accept as their supply and vision monetary model, a tendency to deflation because over time the workers' wages share is the main thing that causes inflation to rise if it's going up. The wages share is going down, and in the model, the wages share does decline. One technical outcome of the model, it has what's called a property, is that if capitalists are the ones doing the borrowing in the model I've shown you, the capitalist income flatlines relatively. The banker's share goes up because of rising debt to GDP. It's the worker's share that falls. So the workers pay for the debt, even though they're not the ones doing the borrowing. And I add borrowing by them, it gets worse because borrowing supports housing bubbles and Ponzi schemes that don't have the capacity to service the debt. So Inflation is a monetary phenomenon driven by class conflict where workers lose out to the bankers and the capitalists think everything is wonderful until the system collapses. Yeah. Speak up. Michael's a great mate of mine, one of my best friends, and he does fun. So we're totally on the same page about that. And given how dedicated they are to avoid about the monetary system, look at a couple of OLG models, so it doesn't have any real impact. We can continue using loanable funds. So I do not expect them themselves. Model a large company would negotiate a line of credit that involves or might be like a $1 billion of credit. So that's stealing like a credit card stealing that the General Motors could access whenever it needed to for wage demands or changes in cost of inputs and so on. And so it's a mutual decision between the two. That was the statement early on. To entice us to want money or actual situation crisis. So it is a concern. That's why I've got separately to lending, okay? Because the banks can do the lending. It's the agents who are already in debt who can decide to repay faster than the banks might want. So when you see a crisis like 2008, it's both the banks stopping the lending and also people who are in debt trying to get the hell out of it and selling assets, liquidating, and therefore reducing the money supply in the same way that loans going negative, if it happens, would reduce supply. When you look at the interesting, when I found I wanted to bring inflation into the model, I really hated the fact that I had to use supply and demand to do it. Of markup pricing. When I solved the equation, Koleski's markup pricing equation says that there's a markup on cost prime divided by labour productivity. So it does turn up there. So a high rate of labour productivity will give you a greater rate of deflation. And that's what we've seen historically as well, of course. Yep, take that out.
Tag und da möchte ich gerne.
As long as this extension cable is not, killing the power. Oh no, it's getting power.
Okay. Hey, okay, it's working. Oh, and it's much better. I think it's much better.
I would send you they on
Okay.
Are you okay with this?
We have a full,
I'll do the registration and send you the presentation by email and ask them to upload it. Thank you.
Self-employed.
Thank you.
That's my general email. Contact these
Thanks for send me an email. Okay. And I will send you the presentation on that mail, and I will kindly like to ask you to upload it on the website. Okay. Because I cannot see the basic. Okay. I cannot see the because of the I
Das sind jetzt 90 Minuten, 1,5 Stunden. Jetzt kommt okay, dann ist nochmal. Okay, also Fragen machen wir, gibt es aber dann die 10 Minuten für die Pause oder irgendwas? Dahinter alle erst okay, aber hier ist jetzt quasi 45 und dann halt so 45 Minuten, 2 Minuten Pause und dann 90 Minuten. Okay, gut.
Should I put this into over here, or
If you can leave it there.
you will leave it here there and change slide with just with an arrow, or okay?
Okay, so please take a seat. The next presentation is by Andrea Terzi from Franklin University, Switzerland. We are a little bit late, so just regarding time, this session will end at basically 5 minutes to 11. Then we'll have another small break, and then we will have the roundtable 1 at 11 o'clock, and then we will stop at 12:30, and we have 1.5 hours of lunch break, and then we restart at 2 o'clock instead of 1:30. So I'll announce this again after the first roundtable has finished. Well, Andrea, through you now.
Thank you, Dirk. Thank you for the invitation. Good morning, everyone. So this, in Steve's words, this is also a small provincial university I'm coming from. Small but good, especially the economics and finance department, but not only that. I've been asked today to speak of this particular topic, central bank deposits. And that has been considered for a long time a rather technical or a technicality of monetary systems with little relevance on macro modeling. This has been true for many years and has changed with the quantitative easing. With the quantitative easing, the attention on central bank deposits has increased, and so the scope of this presentation is about trying to give you some fundamental elements to frame the question of central bank deposits and understand why and how they matter. And because this is in fact the title of this conference, and I know the organizers don't only here mean why money does matter, because there has been answers of this kind. Milton Friedman made this dictum popular to show that money matters in the determination of nominal variables, not the real economy. So we're basically interested in not only that why money matters also means, as we all know, how money does matter. And the answer is simple. We all live in a monetary economy. And the monetary economy is a particular historically determined social mode of transfer value to others. Economics is all about studying how people transfer value to others in different ways, which are not only contractual payments, as we know. They fall under the general category of gift with reciprocity or command economy, hierarchy. But in a monetary economy, people deliver value, and they want to get something back from that value on a contractual basis. And so this takes us to an important question that I will not expand very much on it. I just mentioned because this is a fundamental, important difference between monetary and real analysis. I'm referring to first to Schumpeter, who explains who provides in his History of Economic Analysis, 1954, he explains what real analysis is when non-monetary processes matter, and money is considered only in is modest role as a technical device. And Schumpeter was convinced that a real analysis runs into difficulties. And in fact, he was pretty optimistic at this time, believing that basically real analysis was abandoned. But in fact, Milton Friedman restored real analysis with the dictum, money matters. And I found this Minsky's description of the problem particularly effective, where Minsky explains that to general equilibrium people, prices and wages state the terms on which alternatives are available. And to an operator in a capitalist economy, price and wages are ways to recover cost and obtain funds. So it's all about financial flows. So this takes me to, if we can describe what is the character of a monetary economy in a nutshell, I think it can be explained in this way: a dual infrastructure. You need a law of contracts, enforceable contracts, and you need a payment system. And the payment system implies the notion of finality of payments. And the finality of payments is when the seller of a real value is happy that the contract has been paid, the debt is being paid. And what does that mean? It basically means that the debtor's liability has been replaced by some other third-party liability. So if I get paid, I know that I have no more any further claim on the other party, but I have a claim on a third party. So that's what money is about. And but this thing that I accept in place of the debtor's liability is something that must have some value. And here we should be a little careful, because sometimes we hear the idea that money is purely based on trust, indicating that anything could be money as long as we have trust in it. So even monopoly money could be money. Is if we all agree that it's money, it's money. And if it's scarce, all the better, because that makes it more on demand. In a way, the story of Bitcoin is this, the idea that if we could shift the confidence from national currencies to Bitcoin, it's just a question of trust and confidence. If we succeed in that shift, then Bitcoin becomes money. And the fact that Bitcoin is scarce is in fact one important thing in the mind of the Bitcoin fans that makes it more desirable. Money must have value and must be redeemable in some way, and it can be considered like a voucher that can be exchanged for a value. National currencies, considered legal tender, are redeemable. Redeemable because they offer us a means of payment for paying all public administration, our liabilities towards the public administration, which includes taxes, but also fines, but also payment for public services. It also includes compensations to private parties ruled by courts that must be paid in the national currency. A rough estimate is in the euro area there is some 20 billion euros each day paid to the public administration, maybe more. So that makes it a continuous and constant demand for that currency to pay for public administration. Could a private currency exist, a private voucher? Well, a private voucher could be, I don't know, I could think of a monopolist company providing internet connection. So we all demand internet connection. So this company could issue a claim on time on connection. But careful, if this is issued in units of the national currency, this is not a private currency. To be a private currency, it should be denominated in time of connection. So it could possibly, hypothetically exist, but it would offer an exchange rate risk to anyone who holds this currency, because we have that 20 billion a day to pay to public administration to pay, and so we're not sure about the exchange rate between these two units. So in the end, private currencies are possible, hypothetically possible, but national currencies are heavy on balance sheets, so to speak, are heavy on the balance sheets of people, and that's why they succeed. And so central bank deposits, to go to our topic, function as the national currency. And this is also taken from Schumpeter. And quickly, I just want to overview this terminology by theoretical chartalism that he explains in the History of Economic Analysis in 1954. Is basically what I just described. Theoretical materialism is where we in fact believe that money cannot circulate unless it has some real fundamental value and must be not just redeemable, but convertible into a real good of recognized value. Like, for example, connection time to the internet. And Schumpeter here also, he believes that theoretical materialism is untenable. That's what he said in 1954. But also he includes also these other two interesting definitions. Practical materialism is the idea of someone who may be a convinced theoretical chartalist who, however, believes that because we cannot trust governments to issue this fiat currency, we need to establish some gold standard to control politicians. And also another version, which is practical chartalism, where you could even be a theoretical metalist and believe that gold is in fact the source of value, but say, well, but gold is, you know, is inelastic, costly, subject to fluctuations, impractical, so it's fine. We work with a fiat currency, but this fiat currency should be ruled very carefully. Well, in a way, this is true. I mean, national currency must be ruled, and I think the whole question also about this conference is about to define what are the proper rules to govern the national currency for good policy. And in fact, one of the concluding points of this presentation is that the government of money is a political issue. So as I continue this, I will cover central bank deposits as means of settlement. I will consider central bank deposits under alternative configurations. I will illustrate the connections with public debt and the notion of base money. And starting with central bank deposits, how they come into existence or cease to exist. And I'm happy that I've been given this particular topic, central bank deposit, not just money, because money is a vague word that we should try to avoid as much as possible and speak of particular form of assets, like Steve talked about, bank credit. And I'm glad I'm speaking after Steve having killed the loanable funds. That makes it easier. And so central bank deposits, this is my 10th definition. A liability on the balance sheet of the central bank. That is also a credit balance in the hands of the holders, and that is an electronic balance or a physical object such as a banknote, denominated in the units that are given the name of the currency. So when we say €1, that's like a shortcut to say 1 unit of claims on the balance sheet of the central bank. Of course, that could be also a claim on a bank, and the claim on the bank has value because it can be converted into that thing. And of course, the political authority that issues is the sole supplier. And I'll begin by referring to the notion of central bank money, which is maybe a little more broader or most used than central bank deposits. And these are definitions that are given by the BIS, the Swiss National Bank, the ECB, the Bundesbank. They're all fine. Central bank liabilities used as money, deposits at the central bank, and cash into circulation. And the common vocabulary is that central bank money is, I'm reading below, currency in circulation, banknotes, and banks deposits with the central bank. That's the definition. It is also used as a synonym with some terminology which is not particularly useful: monetary base money, outside money, high-powered money, narrow money, legal tender. Well, base is reminiscent of the gold standard. It's the base of the issue of banknotes, which are all based on the gold reserve. And but central bank money is in many ways only a subset of central bank deposits. A full view of central bank deposits is this. The central bank balance sheet has, on the liability side, that's where money is. And I said money. But I should say really banknotes, deposits held by licensed banks, debt certificates, which are like treasury bonds issued by the central bank, in the euro system there has not been any issue with that certificate so far, but it's a possibility, which might be turned useful for the future of QE maybe. Deposits held by government, and also deposits held by foreign institutions. So, for example, the Swiss National Bank holds euros and can and may hold euros in commercial banks, but recently they moved most of these euros into the Bundesbank. So the Bundesbank liability has a claim. There's a claim on the Swiss National Bank, and particularly deposits held by government, on which I will turn in a moment. So banknotes are central bank deposits in all ways that are just held by the bearer, so they circulate freely, and just reading my bullets on the left hand side, central bank deposit are means of settlement between users. So users of central bank deposit can use them as a means of settlement, and they come into existence, or they cease to exist anytime there is a transaction between the issuer and the user. So when the issuer pays the user, that's where the central bank deposit comes into existence, and when the user pays the issuer, that's where they cease to exist. And because they exist as a result of a book entry, Dirk reminded us the double entry bookkeeping, or maybe it was Steve, and the great invention of the 1400s by someone who's been described as a libertine monk, and published his book in Venice. And because of this bookkeeping technique for creating or destroying the national currency, you need a political rule for issuing it. And examples of political rules are the use of collateral policies, quantitative credit constraints, or monetary financing prohibitions. Means of settlement between users, that can be easily described as the central bank doing what's called an in-house settlement. So two parties having an account at the same institution, one party pays the other by having one account being debited and the other account being credited. This is in fact what happens in the payment system. The euro area system has a platform called Target, now opening up to TIPS, which is the instantaneous payment system, and but in the base case, that is when we begin with a bank with two banks, one making a payment to the other bank, and neither of the two banks have any claim on the central bank. Then the way in which the payment is done is by the central bank allowing an overdraft on the bank that is making the payment, that is a loan. And then the bank, the receiving bank, will have its balance increased by the payment, by the amount of the payment. And this is where loans create deposits, exactly as Steve was describing for banks. That also works at the level of the central bank. And it's only by making loans or by making purchases. I mean, the central bank making loans or the central bank making purchases, that the national currency may come into existence in the form of central bank deposits. And now, however, we know that most of these payments today, well, not so much today with the special conditions in the euro area, but at least until 2006. most of these payments were taking place through the interbank market. The interbank market is interesting to see how it emerges, because it emerges because the central bank sets a penalty rate on the overdraft of banks. And once banks know there is a penalty rate on overdrafts, they become willing to borrow at a lower rate by some other bank. And if bank 2 is pricing credit risk below the penalty rate and above what it gets by leaving the balance unchanged, then banks may settle the payment with no central bank intervention. So the receiving bank can say, you don't pay me, but you owe me an interest rate. And that's the interbank market. And the balance sheet of the central bank is now empty because it all happens between banks and doesn't involve any action of the central bank. Now, it might be interesting, maybe I'll speed out a little, but to see how banknotes get printed, get issued, and get into circulation, because this is also ties up with a notion that's become popular for not the good reasons, the idea of signorage, and which is also misunderstood. I'll go a little faster here, but this goes into 3 steps. The central bank buys the unissued banknotes at the cost of production from the printer, and this means that the central bank makes the payment, sends credits the bank where the printer's account is, and the printer will receive the payment and the deposits. The second stage is when the central bank delivers the banknotes, but for the banks to pay for the banknotes, they need to borrow the reserves to pay for the banknotes. At least they need to borrow the difference between what they received for the cost of production of the banknote and the value of the banknote. That's the signorage. And then the users of the banknotes withdraw the banknotes from the banks. What you see here is the capital of the central bank is going down, not up, because of signorage, which sounds strange, because the banknotes printing is costly. So so that's a loss for the central bank. The signorage comes not from the banknotes and not exactly from that, but it comes from the interest rate that banks will pay to the central bank, and the central bank will charge to banks for lending the money that banks need to pay for the banknotes. Banks are fully demand driven. They respond to the desires of bank clients to switch from bank account balances to banknotes, and so they're sold and bought back. But let me show you the changing volume of central bank deposits in different configurations, because in a normal configuration, which has been basically in the euro area since start 1999 all the way to 2006, that okay, we know that banknotes are fully determined, but what about central bank deposits? Well, central bank deposits are both demand driven and rule driven. The rule driven because there is a minimum requirement that the ECB has set, and which was 2%. Now it's 1%. Now it's 1%. 2% of a certain aggregate of bank liabilities. So for all this time, neither the ratio nor the monetary aggregate of reference changed. So the only change was demand driven, and here the central bank needs to provide the banks that minimum requirement. So once the minimum requirement has been set, the central bank is now will have to provide that amount, which they can either provide on request of each bank, more or less like the very first example I gave you. Anytime a bank needs to make a payment, they fund that bank, or by auctioning periodically, like every week, a certain amount of money, a certain amount of central bank deposits, I should say, that must match exactly the demand by banks, which is minimum requirements plus maybe a little precautionary amount, which is very small anyway, to make sure that the interest rate remains pretty stable. So if we look at the scale is intentionally that way, and the line is so low because this prepares for what happens with QE. But up to 2006, this is the amount of central bank deposits in the euro area. Fairly stable. Of course, the scale doesn't show very much, but anyway, it shows the dynamics of bank credit that Steve was talking about. And we don't see that much, but there is a period of rise, then there is a period of constant, and then a rise again. It goes into 3 phases, and this is how central bank deposits have been determined up to then. Then there is the question of what happens if there is a rising counterparty risk, where banks find that the credit risk would justify asking an interest rate which is higher than what banks can borrow directly from the central bank. So banks will go to the central bank. This may happen technically not only in the case of rising counterparty risk, but also if the central bank squeezes the interest rate spread in such a way that it doesn't provide room to banks to make loans because the credit risk is higher than the squeeze interest rate. Something like this is maybe kind of happening today because the interest rate between the deposit rate and the lending rate is being very squeezed, and just a little bit of credit risk makes it more desirable to banks to borrow from the central bank directly. But also we live in times of very much excess reserves, so it's a mixed situation in that sense. So if there is no market, the central bank will lend to one bank, and hence the other bank balance will rise, and this has been happening after 2007. Here, the bank balances, so that particular category of central bank deposits called bank balances, which are not treasury balances or not foreign central bank balances, but bank balances, have been driven by the demand by banks losing access to markets. And this is what happened between 2007 all the way to 2012. In fact, 24 end of 2014. That's a chart. The peak is 2012, and that's where let's all remember carefully that the peak did not end just because the president of the ECB pronounced the famous words "whatever it takes," but because the ECB decided to establish the OMT instrument, which was a complete innovation, never used, but the fact that it's there addressed concerns about the euro area, up to a point, of course. But that's what happened up to then with the fragmentation of the money market. And it's fragmentation because the banks that lost access are not just scattered randomly in the euro area, but belong to certain countries and not to other countries. And that's why it's called a fragmentation amongst different jurisdictions. And then there is the changing volume. Oof, my gosh. Okay, changing volume of central bank deposits with the asset purchase program when it's not sterilized, and when the central bank is a buyer, And let me go a little quicker here. This is the asset purchase program, and the line that you should look at is the highest, which includes it includes two forms of bank balances, the current account and deposit facility in the euro area. And I should at least be able to cover a couple of points about how payments from and to the government are being settled, because this is a particularly interesting aspect of central bank deposits. The how government funds its expenditures. Well, with no monetary financing prohibition, the central bank will buy public debt, we issue the bank balances, and this is how balances would look like. With monetary financing prohibition, you have a more complicated route by which the central bank does not lend to the treasury, does not lend to government, but lends to the banks that buy the bonds that fund the government spending. Interesting is that the two configurations are fairly similar. Well, of course, in one case, the public debt sits in the central bank. In the other case, the public debt sits in the banking system. But the open market operations of the central bank can switch from one to the other, so that so they're not fundamentally different. And in fact, what happened with QE was in fact a massive purchase of public debt by the central bank. And if we wonder, well, the interest rate at which the government will be able to float the debt with the banks will inevitably depend on monetary policy. This is the 3 months and 6 month short term federal government debt of the United States, and not surprisingly, the policy rate set by the Fed is this. And of course, they go together. This should be no surprise to any of you. But even if you look at the euro area, this is German and Italian debt up to 2006, and this is the policy rate. So the policy rate drives the interest rate of public debt. The concept of base money is probably to be reconsidered in many ways, and let me see what I can. You give me a couple of extra minutes, Dirk. Okay. If we take this is an interesting experiment we can do by considering the consolidated non-government sector, which includes the banks. Therefore, no, it includes banks and the private sector, and also potentially the foreign sector. So this is where the statement that a surplus of the non-government sector must correspond to a deficit of the government sector, and this includes also the foreign sector, and in the consolidated domestic non-government sector now, because I've differentiated between the domestic part of the non-government sector and the foreign sector, we see that in the consolidated balance sheet of the domestic non-government sector, there are claims and liabilities with the public sector, which are those illustrated in this balance sheet. And the net worth will be positive if the sum of the assets minus liabilities is a positive number, and which takes us to let me switch to the relationship in this balance sheet can be summarized in this identity. It's not even an equation; it's an identity. That shows how the change in the private sector net financial assets depend on those different entries, assets and liabilities in the balance sheet of the private sector towards the public sector. and this is an application to the euro area, where we see this picture does not show Steve Kinn's side, right? So it's not the whole story, because it doesn't show what's happening to the credit market or to the private debt market. But it shows that the bars on the positive sides, which are the net financial assets of the consolidated domestic non-government sector, are funded by the bars on the negative side. And we see, for example, that the dark red is households, the yellow is rest of the world, when the rest of the world is a net exporter to us. They are saving, right? So that's where the yellow bars on the positive side in the 2000s, but then they become negative because the euro area becomes a net exporter. So we are the savers and they are the dissavers. So we see how the savings have been funded largely during the crisis, at the peak of the crisis, largely by public debt, the dark green, and since the beginning of let's call it for brevity austerity, the public debt has been diminishing, and fortunately has been replaced by net exports that have been funded savings, the savings of the financial assets. In a way, one could tie this with Steve credit, saying that if credit expands quickly, then the domestic sector may grow even with a low bar. Okay, because credit adds to the existing net financial assets with the public sector. The point where the net financial assets go very high during the crisis is a time of deleverage in the credit market, in the private debt. Okay, let me conclude with this, because it's why we have a monetary financing prohibition, and should we get rid of it? Well, I don't know. I don't think we need to get rid of it, because effectively, and that's the last two lines, effectively, this is no obstacle to fiscal expansion and no obstacle to full employment, if we have a good coordination and good policy between monetary and fiscal policy. It may make the system vulnerable only if this also implies that the central bank cannot deal with the secondary market, which was the belief up to 2012, up to Draghi, up to the OMT. And but the reasons to have it are also weak, or we should have it in a different way. There is a Keynesian argument by which, well, if you have a central bank that is separate from the government, they can, raise interest rates if they see that there is too much expansion on the fiscal side. The monetarists have the weakest argument, where they argue that reserves are inflationary, and they believe in the money multiplier. And this is a form of money matters, which in fact has been used by Milton Friedman to show that the economy converges to a real equilibrium, so real analysis again, and also based on the notion that if the government pays off debt and replaces debt with bank balances, this is going to be more inflationary, which is also not true. This is my last slide, I think. There's no evidence of the monetarist argument during QE. On the top chart, there is the expansion of central bank deposits that I've discussed, and on the bottom chart there is the rate of inflation, and the red line is the target of central banks. So central banks have been less able to achieve the target from the downside to the upside after QE than before QE, which is maybe surprising to some, but not to us. And government of money is a political issue. Thank you very much.
Okay, so thank you, Andrea, and we have 5 minutes for questions and comments.
Yeah, obviously I really like the presentation. I really like the granularity about the differences between the different kinds of liabilities. I just wanted to zoom out and ask if you thought a useful place to go next with this story would be the kind of at-par convertibility analysis of the private liability structures. So particularly, for example, if there are banks that have deposit insurance as well as other guarantees so that their liabilities are functionally guaranteed at par by the public authority, it seems to me that at that point there's still a difference between that and central bank liabilities in terms of how quickly they can be converted, and there are other kinds of risks, but those risks are closer to the difference between like public debt and central bank deposits than they are a private instrument and a public instrument. So I'm just curious how you would extend this analysis to that next layer of the system by looking at, you know, anything that is publicly guaranteed at par convertible beyond just public debt and central bank liabilities.
Yeah. Okay, no, absolutely. And in fact, one of the most critical vulnerabilities of the euro area is the lack of a credible deposit insurance that we know it's been under discussion for a long time. And it seems that the question is, well, you got to reduce your risk first, and then we'll share the risk. And this is a never-ending story, it seems. Extending it, well, the brief answer, I think, may be this. In my identity, I have the private sector net financial assets. So I have the private sector and the public sector, and the claims on the public sector only. Where in the bottom version, I have the DG is the claim on the public sector, G for government, and the DF is the claim on the foreign sector, and DP is the claim on the private sector. So there are the claims between private agents. So that's where Steve Keynes basically comes in. That's the credit expansion, and but ultimately, the value of our deposits, the banks, as you said, are valuable because they can be converted and with high confidence, if there is a credible deposit insurance, into the national currency. And it's interesting how the story about the base money, what was called the base money or central bank deposits, had been considered for many years as a technicality which doesn't really interest us much, and is a dull, boring thing that has become more interesting with QE, and some of the mainstream economists were caught by surprise, I think, but others less.
The ECB decides the size of the balance sheet, and you have this chart where you show how it falls off after 2012, and you said it's mostly because of this OMT, whatever it takes thing. But I think if you look at the interest rate the banks pay each other, the EONIA, the overnight interest rate, you see there's a lot of stress in the market when the banks start repaying this financing. When it's fall off, there's a point that there's a point somewhere in 2014 where you start to see stress in the interest rate that banks pay each other, and I think that's what drove the ECB to decide. Well, there's two reasons. One is they may believe in a sort of quantitative theory of money thing, where they think they need a really big base money to raise inflation. I don't know if you think the ECB believes something like that.
No, I don't think so. Yeah.
The other one is that even though the balances went down, I think the balances went down because banks were signaling virtue by saying we're not borrowing from the ECB anymore, and they were repaying these long-term refinancing operations too early. And you can see it in interest rate, the threshold of stress when the balance goes down. So at that point, the ECB says, okay, if you guys don't want to borrow reserves, I'm going to give you reserves by buying bonds, and I'm going to take away control from you because you guys can do this.
Okay.
So I think you have this presentation on the volumes. I think it would be interesting to correlate that with the price of interbank.
Sure.
Because you see things like, you see the periodicity of the maintenance period.
Okay.
Of the reserves.
Yeah, well, there are two sides. One is the price and one is the volume in the interbank market. And the volume dropped quite significantly in 10, 11, and 12. Today is much lower than then because most banks have excess reserves. And there's also a misunderstanding that I've noticed by some people who believe that countries with countries where the central bank has a negative target to balance, that means that they are short of reserves. No, Italy, for example, has a significant negative target to balance, but excess reserves. There is a significant amount of excess reserves in the Italian banks. I see your point. And the price in the market was always gravitating around the middle point between the deposit facility and the marginal lending facility, but with a lot of stress, as you say, and much volatility.
At that point, you see that in 2009, the ECB switched from fixed tender
to full allotment. Yeah. Fixed rate, full allotment.
When they do that, you see that the funding rate of the interbank market goes from the middle of the corridor, the repo rate, to the deposit rate, and it hasn't left the deposit rate yet, so it's at the bottom now.
Yeah.
Before 2009, it was in the middle. After 2009, it's at the bottom, and that correlates with this change of policy of the ECB in terms of this quantitative or price driven. So that's another place where you can.
Yeah, you refer to the system. Yeah, you refer to the system of the corridor, which is in a way, it's a complicated way to run the control of the interest rate.
We talk about that when we talk about how the banks borrow at the bottom and lend at the top, and the credit risk. Only credit risk justifies lending within the corridor. So
Yeah.
you're implying that. When you
Yes. Yeah. I think behind that there is also the belief that the interbank market is useful because it's a way to communicate information between banks, and banks can price credit risk of other banks. But one could also argue that the central bank, as the supervisor of banks, knows better the balance sheet of banks, and so the interbank market may not be that significant in measuring the credit of different lending institutions.
Sorry, we are running out of time.
Yeah.
So I think what we'll do is now we'll do a surprise coffee break. So those who still have questions can ask a little bit later during coffee. So there's coffee and water just in the other room, but please use it all.
Okay, thank you very much.
I'll see you in 15 minutes.
Oh, sorry.
Yeah, thanks, Andrea. Very nice.
It was good. I had to run a little bit.
No, but
at the end, but
but it was important, the last bit especially. So that's great. All right. So
you go for coffee.
Yeah, I go for coffee. I have to organize some stuff.
Especially that chart, no? That is diminishing, you know? It's diminishing, so either.
There we go.
Well, this is increasing, yes, but it's diminishing in the sense that the trade barriers go from
So can you,
Yes,
I
hi.
just want to
Hi.
say hello. Yeah, from Poland.
Yeah, right. How are you doing?
Very good.
Okay,
Just
yeah.
wanted to say that the bank was a good, not the best, but a very good.
Oh, that's good. Excellent.
So we are waiting for the revised version.
Well, I've got to start writing it. I hope sometime this year.
But you are going to write a
I am.
revised version?
Really, I'm dissatisfied with the section on money.
Okay.
And I need to add this stuff on energy that I
Yeah, the chapter is
a bit old-fashioned. It's before I realised the importance of double entry bookkeeping.
Yes.
So I've
Yeah,
got to,
we talk about this.
Yeah.
And are you working on some other book?
Oh, I've got 3 or so I've got to get going into. I've left Kingston, so I'm not working
Yeah,
on
I know.
anymore. And I've got a whole lot of media tasks. I'm speaking at the European Central Bank on Tuesday,
Yes,
for
I know.
example.
I'm
so I've got to
following
get that.
Twitter too.
Yeah, so I've got to do that. But when I get that out of the way, I've got about 3 other ones. I'm putting a cartoon book on money.
Yeah, the one that you show on the.
That's actually it already exists. This is one more of the same cartoon. It's called Funny Money, which is it's Kickstarter campaign. I Kickstarted.
Okay.
2 writers started. I've got to do the time project. I'm doing it properly. And then one called Matters Because, which is a book for school students. Contributing my own draft over, not having written a draft for it yet. And so that'll happen before I do debunking. But I'll
Okay,
it's like
perfect.
by the end of the year. I'll start it'll be about 3 months work, I think.
Okay, when it's finished, we'll start to work on the book.
Fantastic. Sure. Yeah.
I could not quite sure.
I get so many faces. It's
Yeah, I've read the book, Debunking Economics, and then quite another financial crisis. First one became quite long and I really liked it. It's very good. Now I'm trying to find a way to work with these ideas.
in your own area. Okay, yeah.
Yes, it takes some effort. I studied physics, so just
You
physics.
studied physics, well that's
Yes.
good, you've got a good start. We need a good system of economics, definitely.
Yes, that's the idea. No, I just finished my master's.
Oh, that's pretty solid. Yeah.
And I theoretically.
Okay. Which university? Huh? Okay, yeah, no, that's right. Okay, right, yeah, I'm in Holland, okay.
Yes.
Where I now live.
Oh, you live
Living in Amsterdam.
Great.
Yeah.
Great. Yes, and it's. I also talked with Dirk Bezig.
Pardon?
Dirk Bezig.
Oh, yeah, okay, the pronunciation. They're always completely thrown in.
And some of his courses, there's like one course in banking and 3 different subjects, new case and post-pension and Austrian.
Yep.
And one on global finance. But it's,
that's a bit difficult, of course. I'm slowly progressing, and now I'm trying to first job programming.
Oh, I'm programming. What's your programming specialization? What do you program in?
Yeah, I did a bit in Java in finance, but a lot of companies they program in Java. So
Eine Reihe?
programming, data science kind of skills, and doing they do both C++ and Java, so I have some option about choosing between the
Yeah, yeah. I think C++ is powerful.
Ja, wir setzen sofort.
I think we adapted in Twitter, Twitter store.
Oh, indeed, yeah.
So I've been reading Godly's and Laporte's work.
Yeah.
Before Godly died, right?
Yeah, that's right. Yeah, 2020.
And I've always been intrigued by the stuff like consistent modeling, and I think a lot of what he did is behind your work.
Oh yes, I mean the only difference would be in winners that win, and Mark still used discrete time and it's a strong modelling framework, but apart from that, very consistent.
Yeah. So I've been trying to do some work myself.
Yeah.
And, of course, you start with spreadsheets. That's limited. Then you go to R, which is a free software.
Yeah, I know.
But then you run into a lot of challenges, especially when you start working on linear equations. That becomes
Yeah.
I was wondering how you solve it.
Well, I use Minsky is designed for non-linear modelling, so it's it's just the dynamics way of building a set of equations. You're basically making a flow chart, and that's what I do with Minsky. I also used to use MathCAD. MathCAD is unfortunately been taken by a bunch of marketing lunatics and screwed it up completely, so I'm using a very old version. But MathCAD has got very, very powerful ODE solvers in it. So how do you know differential equations? Are you okay with differential equations?
I'm sorry?
Are you okay with differential equations or not?
No, I'm not.
Okay,
You have to. You have to forget about doing discrete time. So what you need to learn is basically differential equations. You can teach yourself that through the Khan Academy, pretty straightforward, or you can get hold of my favourite book. It's actually sort of book you can read in bed. By a guy called Martin Braun. Okay, and that's ordinary differential equations and their applications. It's brilliant. Show how to use that as a modelling basis. So that's what I suggest. But then you can handle stuff like this.
Alright, I think I'm going to sit down because
yeah. Hi. Yes, Marcus. How are you? From where? From Patreon. Oh, okay. Oh, thank you. Yeah. Nice to be able to thank you. No, that's fine. The numbers that count. Yeah. Oh, that's right. Anybody believes it doesn't
name of the?
Brown as in AU. Okay.
It's very, very readable. Teaches modeling very, very well. So you haven't. I'm leaving about 2. I'm going to get the train out to the airport.
Okay, can I get a round of applause for our first panel, please? So to my left here is Elisabeth Springler from the FH SPFI Wien, and to my other left is Sascha Bützer from the University of Munich. He's also consultant to Germany's director at the IMF. And we're about to discuss why money matters. I'm sorry that Peter Bofinger is not here. He's down with the flu, so he's in his bed with fever. He cannot make it. He says that he's very sorry, but he wishes us a lot of success. So since this is basically down to the 3 of us, I thought that we can basically then use the opportunity to cut down the time also a bit. So we will continue this until 12:30, and then we meet back here at 2 o'clock sharp. There's a very nice coffee place downstairs, but again, there's also restaurants. So if you want to go to a restaurant, we have time for that. And if you want to have a coffee afterwards, we should have time for that too. Again, there's a small coffee place just downstairs here next to this building. Okay, so I think Sascha wants to start. So what do you think why money matters?
Well, so actually we already heard really interesting talks this morning, and which partly covered some of the stuff I was going to allude to, and maybe just to pick up on what Steve Keen said earlier this morning, why money matters. I think it's really crucial if you look at mainstream macro modeling, and like you said, I when I went, so I studied different universities and actually never heard about the concept. I was only exposed to post-Keynesian economics actually after graduating, and a lot more makes sense when you think about it this way. As Steve also said, all these puzzles that you see. And I worked after university. I started working at the ECB and Bundesbank now IMF. And when you go to these mainstream macro conferences, there's always so many puzzles. And with a little bit of common sense, most of these puzzles would simply disappear. And things become a lot more plausible. And without making it more complicated, I very much subscribe to what you said. I mean, when you just look at identities, like savings equals investment, basically what you learn in Macro 101, that certainly holds true, but the causality is just from the reverse, right? You don't need savings to invest, but once you get a loan in order to undertake investments, savings are created in the same moment. Right now the challenge is, how do you incorporate that in modern macro models? Because basically when you, and correct me when I'm wrong, but from how I understand, when you had, after, the, post Bretton Woods system, you had these competing schools. You had, Kalecki and Cambridge with like very reasonable business cycle models, and then Solow, of course, was a smart guy. Well, his growth model, which basically relies on that flawed misconception on savings and investment because money is absent, that just became the predominant scheme in neoclassical economics, providing the base for basically all of modern macro quantitative macro models, DSGE models. Now, when you talk to DSGE people, who are very smart people and usually really well intentioned, work with them all the time, they just don't really think about it. And once they would start thinking about it, they would have to completely reconsider their entire education, all these years of educational investment that they have put into it. It's too bad that Peter Bofinger is not here, because one of his colleagues at the Council of Economic Advisors in Germany, who's responsible for monetary policy, he has these huge DSGE database, from which, and in none of these models, money is modeled accurately. And actually, when my colleague pointed out to him, after that Bundesbank paper came out, how money is created, he was saying, well, also the Bundesbank is sometimes wrong. So it's like the orthodoxy by itself, but it's just, and it's not. I mean, it can't be an intellectual challenge because it's not that hard to understand. But I think it's really just that vested, all these years you have put into it, all these brain power. And it's funny, like, you know, the central banks, also the IMF, you have these weekly research seminars, which are usually quite stimulating, and not all of mainstream economics is useless, of course. So there's lots of really interesting applied macro empirical stuff, microeconometrics. But when you look at modeling, you have these people coming in, calibrating their models, having, you know, new perturbations, and they invest so much time and energy into something which is completely flawed from the core. You know, it's and once, you know, sometimes I just, you know, raise my hand, and sometimes they have money in it, sometimes they don't. When they have money in it, it's usually in the way that households have to forego consumption, right, in order to bring it to the banks if you have financial intermediaries, and then these banks can lend out to firms to maximize their profits. And when you ask the question, well, where does the money come from? You know, they basically stare at you blank. It's just not, sometimes you have a growth function from the central bank, which would, you know, suppose you actually have a constant money multiplier. That this might somewhat of a reasonable assumption, but it's not, though, especially when you need it at the zero lower bound, at the effective lower bound, when the money multiplier correlation collapses. That's when these models become completely useless in predicting what's going to happen or in formulating policy advice. So I think now the challenge becomes, you know, where do we go forward? And I think it's very encouraging right now when you look at Alexandra Ocasio-Cortez, for example, who's one of her main economic advisors is actually Stephanie Kelton. So in the policy sphere, you get some of these concepts because it's intuitively appealing, I think, to a lot of people without going into the money details. So you have somewhat in the policy realm already going on. Now, what's going on in academia? And I think I again have to agree very much with what Steve said, that essentially there's somewhat more openness at central banks and international institutions like the World Bank, also the IMF, where you have sort of like a safe job. You don't have that pressure to publish in mainstream journals all the time. So there's somewhat more of a free thinking, and also you just look at reality, right? That's why I think what he said this morning, what you found appealing about modern monetary theory, that it's actually not so much of a theory, but just a factual description of reality, right? So I think the theory maybe does a disservice to the concept, because it's simply, without the normative part, of course, what government should or should not do. It's a simple factual description of reality. And I think what is a very promising avenue to pursue is to take these articles from very orthodox institutions like the Bank of England, Bundesbank. Kumhoff has a great blog entry called "The Truth About Banks" on the IMF website, I think from 2016, which summarizes this very succinctly, and yet it hasn't really found its way into IMF policy advice. But I think that's what you can take and say, well, this is just how it works, and quantitative macro guys need to catch up. Like it's basically, and that's, I think, once you ask them really simple questions, you get a lot of people thinking. You know, if you say, well, banks can only lend if they collect savings, just ask them, well, where do people get savings from, right? And it becomes very circular very quickly. And so I mean, I invested a little bit of time last summer, for example, to edit the German Wikipedia on it, which was terrible, just plain on terrible. And they still had an old reference to the money multiplier, which was in the Blanchard-Illing textbook, which actually took it out in the last edition. So I think it's still not really embedded yet, but I think that's something where you have to start with young students in textbooks, just get these crazy concepts out of there, and then students will start to think for themselves, I think. And I think for lay people, I mean, whatever Wikipedia you're using, also the English one isn't particularly great, but it's a little bit of work, but it's quite rewarding. This is just factual descriptions of reality, right? It's not, this shouldn't even be debated, right? I mean, this is just to be accepted, and then you can say, well, you know, how large should the deficit be, or what is the government spending money on? Of course, you know, we don't want government spending on fancy cars for the ministers or whatever, but I think that's the debate one should have, and not whether this is true or not.
Okay, thanks for saying. So the next statement.
Yes, my next statement. Oh, well, my statement. I would like to give a more Austrian perspective, well, not in a sense of an economic school, but rather from a geographic reference. I perfectly agree with the theoretical foundations that we have today, because I think that I can also agree with what you said, that it's, of course, very intuitive, that we try to explain what the real world is around. But I disagree in the sense that it's already common sense for many politicians in economic policy. I think you mentioned somehow that it should
slowly
be translated.
getting, yeah.
Well, from two perspectives. From the one side, as I'm also a member in the Fiscal Council in Austria for debt mechanisms, and in the Stability Board for Financial Stability, which was created after the banking union, I somehow feel that they're not always on my side, whether the contradiction holds in some cases. But for me, what I want to focus a little bit more is on the empirical evidences that we've seen in some other markets. So far, we talked a lot on the pure effects of macroeconomic modeling. So I want to focus how we see what we try to model there in the real world in one sector, and this is for me the housing sector, because that is I think for me the perfect example how we see that what we try to explain is visible, and somehow the current macroeconomic situation and mainstream economics try to put the argument around so that their mainstream fantasy of liberalization of the financial market still holds. And I want to tell you why. So the puzzling thing here is Austria, because Austria's housing market was always regarded to be a very, very stable housing market, with not a lot of house price increases, not a strong rent increase. And before the financial bubble and the burst of the bubble and then the financial crisis, we have seen those stable prices, unlike most southern European economies where we've seen those housing bubbles, especially in Spain. And we all blame them that they went through this financialization process, and suddenly they had lots of securitization on the market, and that was the reason for the housing bubble. But then what happens afterwards was that we used monetary policy, and this is where money matters comes in. We used monetary policy to somehow offset the negative elements of the financial crisis, and as we've seen, once we want to spur inflation, that means that that has to increase somehow, and whose back is that really taken out? And this is carried out on the household's back. So this is what we see now in Austria, because whenever we had this asset purchase program, which was not sterilized anymore, we see that suddenly house prices, especially after 2012, started to increase tremendously. And nobody couldn't explain why should that happen in Austria. And at the same time, also the rents started to increase. Approximately 1 year later, or let's say 18 months later. So what we see now is a very dynamic housing market, not only in Vienna, but the whole of Austria for the ownership and the rents. So when we try to dig a little deeper, what happened according to that loose monetary policy is, for me, the example of a very strong financialization process, which was undertaken in the same time, and means that we have changed something on the underlying institutional structure. So for me, this means that monetary policy is somehow used to give a new area of freedom so that households can really fulfill what we see, what's happening in those macro models. When we see in the macro models that households should increase their debt positions, we have to ask ourselves, how could that be done? So at the same time, some policy implementations have to be fulfilled, that this macro models, as we see it's forthcoming and as holds, is still working. And it's working that way. So somehow it's the proof of the underlying macro model, but we don't like the result. Because the result means that this increase in house prices means that on the one hand we have an increase in home ownership rates. This is somehow the first step towards financialization, from a very strong rental sector to an increase in homeowners. And that means that Austria is lagging behind that. Many other European economies did that step before, already in the 80s and the beginning of the 90s, when financialization started. But in Austria we still have approximately 55 to 60% renters. So So what we aim for, and this is also what politicians are now carrying us to do, is you have to choose your own prosperity in the future, so become a homeowner. And the underlying financial spectrum gives you all the opportunities. So the opportunities are carried out at the same time as our loose monetary policy gives us the possibility also to take out a loan at a lower interest rate. So if we really do that, that means that in this case we get an incentive from the central bank, but we are really the ones who are then increasing our demand. And as increasing demand then works, still, that's true, we have prosperity because we know that the housing sector is the main driving force for a business cycle. It leads to the boom phase in Austria. We have strong investments, not only in the whole area of housing, but all other areas as well. But at the same time, we see that the first step is done already. So a lot of households are becoming homeowners. They're trying to increase the homeownership rate. But then there is also the second stage. And also the second stage is somehow transmitted via monetary policy, because that means we have a new area of speculative demand, which is not the so-called primary demand that we have with our households, which is already fulfilled with this deep and strong increase in interest rates. But parallel to that, and that's what we see especially in Austria and in Vienna, is that the speculative derived demand increases. And that means it's not the primary house for housing anymore, but we have lots of empty flats around there, but we start speculating on that. And that drives up house prices another time. So those who are rich already, and they become richer again. So the whole situation means that loose monetary policy in the end has a positive impact for the strong negative distribution effects that we have. And financialization on the other means that those households who are already lagging behind have to increase their debt ratios so that they have their primary demand fulfilled. They are not profiting on the derived demand, on speculative demand. So the combination of loose financial markets and also the shift in the national financial system that we see, and when we are now opting for a new capital union in the European Union, that means of course that financial sectors and the underlying financing structure moves towards a more liberal financial sector again gives more possibilities and opportunities to invest, and for those households to rise and build up their debt positions again. So what we end up now is a dynamic housing market with approximately 12% increase annually of house prices. And we had some years when we also had like very strong fluctuations, rents increasing 8%, 10%. It always depends how the underlying structure is. So far, we are not fulfilling the German model, because the German model already said increasing the free liberal rental sector. So Austria is not doing that at the moment because we have a very strong non-profit housing sector. And this non-profit housing sector is really pushing down a little bit the rents. But we're moving towards the German model, abolishing more non-profit sector, because that's not fitting in the politicians' opinion of having our own possibilities to create prosperity in the future. Because obviously the state is not doing that. And if the state is not increasing that, then we have to do that, because otherwise our model shows that it's not working in any other case. And it's true, the politicians seem not to know that.
Yeah, thank you for these two perspectives, which fit together very nicely. So I think it's kind of clear that money matters to every person. And if I can basically jump from your talk to back to Steve's talk, I mean, what you are basically saying is that if you want to spend money, you have to somehow create money, and of course you can create that by private debt. So of course one way to kick off an economy is basically to increase private debt. And how do you do this? Well, you try to increase some kind of speculative feeling in the economy, so that you basically try to get house prices up. You can politically manipulate a bit. In Germany, for example, the allowance that Hartz IV people get, so those who are long-term unemployed and other people who are falling below the minimum wage, If they have a flat, then they can get more money now than they got 5 years ago. So this of course helps to increase rents because it shifts up the level of those who are the poorest. And then you are basically creating this kind of institutional framework which allows you to run your economy on ever increasing house prices. Even Paul Krugman noted that once, I think probably like 10 years ago by now, that the American bubble is run, or the American economy is run by a bubble in the housing market where Americans get rich by selling each other houses at ever higher prices. Okay, so even a figure like Paul Krugman understands that. So the question is now. So the question, of course, is if the monetary economy is based on increases in spending and it's based on increases in debt, the question, of course, who has to carry the debt? So from the perspective of the economy, should it be the public sector? Should it be the private sector? Should it be companies, households? And of course, what we are seeing right now in Austria, and we've seen that in Germany as well, is that basically the institutions have been reworked in order to make it possible for private households to load up with debt. Because the firms, they have surpluses, so they don't want to borrow. And that, of course, is something which I think is connected to, of course, the macroeconomic situation as such. So one question I have to you, Elisabeth, what is the Fiscal Council in Austria talking about? Can you tell us anything about that? That sounds very interesting.
Well, that's like in every member state of the European Union, there has to be now this fiscal advisory board and council talking about the debt of and the deficit situation of the public sector. So we are quite happy, of course, that the interest rates are decreasing that much because Austria was definitely profiting a lot because with that lower interest rate level, they could diminish the deficit, and well, that's why we are within the frame of the MTO, the medium-term objective, and can meet the criteria. But nevertheless, the positions framed within the council are, of course, that several institutions are putting members up to that council, and that's how the opinions are split up. So the Chamber of Commerce has a different opinion than the Chamber of Labor. So that's how it's transmitted also in that advisory board. So in the end, this is kind of a watchdog to keep up with the criteria and the guidelines set up by the growth and stability mechanism and the implementation of the 5 and 6 packs of the European Union. So somehow they have to guide the protective and the preventive arm of the stability and growth pact.
Okay, well, thank you. Well, to Sasha, I think it's interesting that you mentioned the textbook by Blanchard Illing, because some years ago I was at a workshop here, financed by the unions, and there was also Mr. Illing was there present. And then some student got up and said, look, your monetary theory in your textbook is completely wrong. and everybody was like, yeah, it's completely wrong. And he said, well, if that's the case, I should take it out. It's like saying, you know what, you people in the Christian church, in your Bible, it's not really clear historically that God ever existed. And then the Pope says, well, we'll take him out, we'll write him out. I mean, to do macroeconomics without talking about money, it's ridiculous. I mean, what kind of exercise is this? We're living in the 21st century. And of course, the role that money plays is very important. So what might be then different, or what might be difficult, different setups to the one that you described? What could we do instead of piling up private debt more? Because I mean, private debt, the problem is if asset prices go down at some point, like they did in Spain, Ireland, US, so we've seen that happen quite a lot. So it always means you get into some kind of recession, debts are not going to be repaid, people will be losing their houses, they will be out in the streets while the houses are empty. Is there any alternative to this kind of economic policy?
Well, I think the underlying thing is that there is still a lot of ideology behind that, but it just doesn't mean anymore that the state should do it, but currently it's like every private person should do it. So when we go back to the equation, we would just say like shift it backwards and say, well, also the state should be allowed to have a lot more responsibility for those what we are aiming for, and what we are aiming for is more or less to have a setup of the kind of a welfare system, because what we should count for is every citizen. So So if that is our frame and our economic policy, and then we think who has then to put up with some responsibility, then I come back and say, well, some kind of state should do it, so we should reframe our institutional setting again, so that it's not the case that every individual should pile off that. But there should be a little bit more control and production of housing in the case of the housing sector. So it's shouldn't be left to the speculative demand, but the production of affordable housing, and that should be the public sector's incentive as well. With different cases are coming from, like the weakest form should be then public-private partnership, and the strongest form could be a total public provision of housing, as we had it also till the beginning of the 2000s, also in Austria. So that was the time when we started to abolish the direct production of provincial housing production by provinces and cities. So till that was also common. So that's not all left to non-profit organizations, and that's always in discussion if this should still exist. So when we reverse that spiral, then I think we can't do anything in closing our financial sector. I mean, we can't do that. We are connected, and within international corporations and global mechanisms of financial markets, I think it's a very nice idea, but it's not very forthcoming to think that Austria, somehow an island, can just shut down all the interrelations on the financial sector with anybody else. So if that's not possible, then we should opt to the other turning point, and that's for me the institutional structure.
And you mentioned, I think, the reforms of the European Union. So now what is allowed in the European Union is securitization, which was not allowed before. So I mean, if you look at the IMF, I mean, the IMF probably wants to understand where's the risk. Okay, so there's a lot of loans outstanding, and then there probably are some non-performing loans, like in Italy and in other places in Europe, Spain probably. So is it not very complicated that when the European Union allows for securitization, which means that banks can sell off loans to other banks, that then the risks are spread around? I mean, they're not gone. So is it not harder or do you have any opinion on that? Whether it's possible then for the IMF to predict where the next crisis will hit, because you're now selling off the loans to some places where you don't see them, basically.
The question's for me?
Yes.
I think she's
your private answer.
Actually, I found your previous question a lot more interesting. so maybe I'll just add to that, and if you still want an answer to the second one, I can briefly discuss that one. On I think the perspectives for debt and growth, I think that's really the issue here, because in the current system, they are inherently intertwined, as Steve has also put out. You know, it's an integral part of what you have to look at in terms of aggregate demand. Now, one proposal, of course, by Michael Kumhoff was, go back to the Chicago plan, separate. There's also a good paper by Roman Berry-Spiegel from the Swiss National Bank about separation of money and credit, where you basically would go to they had this initiative last year in the referendum, where basically you would actually put central banks in charge of money creation. And I'll give a brief talk about that this afternoon. Some shameless self-promotion. But in the current system, where money is created exclusively by commercial banks when they extend loans, then of course you can't discouple the two of them, and then the debate has to be about the quality of debt. So that maybe pertains to your second question, because what we've seen over the last 20, 30 years essentially is basically that bank lending has increasingly gone to housing market, mortgage lending, and and a decreasing share to productive investment. And from that results, of course, one-to-one, your debt to GDP dynamics, because investment if you give a loan for investment or consumption, with investment obviously being better, that directly has an impact on GDP in that year and possible knock-on effect. So you wouldn't see a change in the debt to GDP ratio, whereas when you give a loan for existing real estate, which can make sense, and if from an intertemporal perspective for people to buy a house or whatever, then it doesn't enter GDP instantaneously and only very indirectly, so it increases your debt to GDP ratio. And a lot of what we've seen now is that those loans, they're not usually for first-time homeowners. That's not really what's driving the market then, but it's there's a lot of speculative activity. Secondly, if it goes to first-time homeowners, if you look at the U.S., that usually made up for stagnating real So I think inequality is a big part of this discussion, why we see these increasing shares of debt to GDP. And once you start addressing that, again, through, for example, more progressive tax systems, estate taxes, you immediately address the need for ever-increasing leverage for lower and middle-income households. So I think that's these debates should be closely linked with one another. Then on the point you briefly mentioned about going back to the textbook, because actually Professor Illing is my PhD supervisor, so I was trying to redraft large sections of that book last year, and it's just a lot of work. I mean, it's I mean, you have to redraft it from the bottom up, and to give them credit, I think, and also to give Krugman credit, at least they engage, you know, and they think about it at least, you know. And there's a lot of people who refuse to think about it, and as you said, he's open. He's like, okay, if this is wrong, and you don't give too much thought to it, as most economists do in university, you know, just tax along. There's no ill intention. So I think it's the mark of an academic to say, well, if you know, if the facts change, you change my mind. If you learn something, you change it. But so we were trying to switch it a lot. I think his main take was, well, this is easy for pedagogical reasons. You know, this is easy to understand. I'm like, well, it's, actually, the Bundesbank has for high school students. They have a book where they explain money creation in very simple terms. So that's not the issue. And plus, you shouldn't teach something just because it's easy if it's wrong, right? So, but then, secondly, of course, if you really are serious about changing that section, apparently Professor Blanchard is right now redrafting that money section on which the book is oriented. But if he's really serious about it and he takes this on board, then basically he also has to discard large swaths of the rest, and also a lot of his research which was based on that view of either money neutrality or constant money multiplier, and base and broad money are essentially the same thing. So I like what you said about base money, that it's actually a misnomer because broad money isn't in any way based on it. But I think this is a long and lengthy process, but I think it's a good way once you have this factual description of reality, how money is created, you can change a lot of narratives about policy making, about monetary and fiscal policy. So I think this is more important than the securitization question. Yeah, but maybe
let me
yes.
let me come back to the securitization issue. Well, when you think of who is receiving financing from for housing, and so it's housing organizations or individuals. So it's not only a question of pure individuals and private households receiving here additional money, but it's also the fact of other organizations, private investors receiving more money, and this is going to be sold off and securitized. So what we experienced in the past was as well that whenever you have a lot of liberal markets on the financial spectrum, that you have an increase in non-performing loans. And what we did in the last years was that whenever we thought about macroprudential regulation, we tried to see how the symbiotic thing between the several markets is. And then we now try to figure out that Austrian banks, for example, might maybe quite hit by some downturn in Central and Eastern Europe, then that is the macroeconomic approach. If that is not securitized within the European Union, you don't see that clearly anymore, because you don't see anymore what is sold off to Germany, you don't see it clearly what is your own bank balance when it's in Central and Eastern Europe. And all the efforts that you did so far to diminish non-performing loans seem to be not that effective anymore. So for me, whenever you talk about financial stability, not necessarily in the housing sector, but also in the banking sector, I think selling off and securitization means 2 steps back to what we have achieved right now, because in the last 5 to 6 years, the European Union incentives and all the member states incentives was that you should have a strong the linkage of macroprudential regulation, try to see what is the tier 1 capital in reality, does that fit to this combination of risks that banks really hold. And again, in the case of Austria is we're an overbanked economy, and therefore for us that's tremendously important to look at daughter companies and other interrelations to the member states of the European Union. So that's, and I'm not from the IMF, so I can speak freely.
Well, I can bring in Warren Mosler, who once wrote a paper on financial regulation, and he said securitization has no public purpose. So it should not be allowed. So if a bank makes a loan to some person, well, it's good that the bank still has it on the books, because if that person or firm does not repay the loan, then you can see the financial condition of the bank deteriorating. And that is kind of what you would want to have in a capitalist economy, that those banks who are not taking care of their loans, and they give loans too freely or too cheaply or to people who cannot afford to repay anyway, that these banks then have financial problems. But if you basically give a bad loan to somebody, a liar loan maybe, where the documentation is basically wrong or false or falsified, or even it's criminal activity, and then you're selling off the loan to somebody, rewrapping it like it happened in the last financial crisis with the collateralized debt obligation, then of course it's very confusing, and it's not clear what is cause and effect. So of course when we discuss the monetary system, we have to discuss these institutions and whether we allow some sales to be made or not. And I mean, one of the things that you could keep in mind, which is Walter Moss's idea, that is that you always have to think about the public purpose. So is it good for the profits of the bank? That's not so important. The important question is, do we improve the economy by this? So are we better off? Are we better off by having banks selling loans they don't like to other banks? And well, I mean, this is like saying I have a huge heap of junk in my backyard, and I just shift it to my neighbor's backyard. Are we better off as society? No, we're not. Okay, so are there any thoughts at the IMF or at the Fiscal Council basically to reorient policy and say we don't want to do what is profitable, but we want to try to build institutions that benefits the public purpose? Is there any change in the conversation over the last 2 years?
Maybe I have a slightly different view on what you just said. And again, I would like to refer to Steve, what he said. I mean, capitalism is a marvelous thing in providing, it can generate a lot of welfare, innovation, progress, growth, and it has to work for everybody, right? So I'm all in favor of strong regulation and strong social welfare nets, and certainly there have been excesses, but rather than somebody having, I'm a bureaucrat, right? I work in these institutions, and rather than having these bureaucrats decide on what should be done and what not, I think you can let banks do securitization and let them do what they like, but just have really high equity ratios so that if they have losses, they bear the brunt themselves. I mean, in the Chicago plan, basically all investment vehicles would be equity only, so you have a direct bail-in. And I think that was the problem in the last financial crisis, that banks were just massively undercapitalized, and then taxpayers had to step in and rescue them. But I see there's a financial stability expert from Bundesbank sitting over there, so maybe he also has some good points to offer. And I think there's also some sessions on bank equity over the course of these 2 days. But I think that's my personal take on it. Generally, I think there's a strong move, of course, to make the financial system more resilient. But I would be somewhat more reluctant to outright ban certain things, because then you get into all kinds of social planners, what's socially beneficial, whatnot, and rather have try to have a resilient financial system with high equity buffers and progressive taxation systems such that bankers don't go home with. I heard this anecdote about Davos 2 weeks ago. I think it was a hedge fund manager, when he heard about the 70% marginal tax rate proposal above 10 million. He was really concerned about himself, that he might not only get to keep 300 million of his additional 1 billion. So I think this is this is the stuff we should be talking about. Let them do their thing, and if they do risky stuff, they take the losses.
Well, let me answer briefly to the second part as well. When we think about the regulation of the financial market, and we heard a lot about Minsky and thought about re-regulations, and to me, of course, it's from a post-Keynesian perspective, always should be stronger asset-based regulations. And what we have so far with Basel 2, 3, and so forth is not asset-based, but it's again focusing on the risk of the borrower, and then building up on the tier 1 equity ratios, which is not asset-based, but the risk of the borrower. So that should be the first step towards a complete change in the system. But the even more important question to me always is, what is the financial market aiming for? What you said, that should be then a shift again in the ideology that we have, because so far all the mechanisms that we are undertaking is to diminish the riskiness of the system, but let them do whatever they like to do in case of earning money and not whom they are profiting. So it is the question of, do we want to use the financial sector to do something that we're all better off, or do we want to diminish the riskiness of the financial sector itself? And I think that is a completely different question that we have to address. When we want to shift the meaning of the financial system, then we also have to shift the financial regulation and change the underlying system. When we just want to make sure that those who earn tremendously lot money out of the system also pay higher taxes, then we add up some new changes into the existing sector, in existing things like the progressive income tax, so that those are not earning too much. We were not changing the aim of the financial sector as it is right at the moment, and that means creating profits for its own sake, and not for the sake of the civil society or for the households or for whomever it should be. So that's on us to define. And I think that's also the thing that macroeconomists should clearly address and should not step back on that, because to me it's always important not to hide behind the model only, but also transmit what the meaning is for the civil society or for us. So coming on back to your first question, let me put it like that. These councils are always resembling also what the voters are aiming for, because they are somehow set up after the elections, and then after some time, when there were re-elections in between, there is also a new setup of the whole council. So that means that also, of course, the discourses might change over time due to voters' opinions of who should be in power in countries. So there's going to be a new change also in Austria, of course, in the next months.
Oh yeah, okay.
Yes. So I'm definitely not in that council anymore.
Oh, okay, sorry to hear that.
No.
We're glad to have you here now. So. Okay, so I think that connects somehow back to Steve Keen again, because you said that capitalism is important because the private sector can be so innovative and it has to be financed somehow. I think that is basically the nexus that we're talking about here. So we want the financial sector. I think we all agree on that, but they have to be judged by the results in the real economy. And this is, of course, something which we have to think about as society. So how do we get the results in the real world, and not instead of getting one financial bubble after the other.
That's three.
Or three. Okay, that's three. How do we get that? And I would like to open the floor now for the last 20 minutes, I think, for questions and comments from the floor.
I think of housing as a public purpose. I was thinking, should governments not have a buffer stock of housing to keep prices down, as well as housing people, in the same way that we view a job guarantee to provide a price floor? We can use a house guarantee to provide a maximum, to stop the prices going too high, to discourage people from then buying places just to rent, ever increasing it, as a price stability as well as a public purpose. Wouldn't that not be worth thinking about?
I think you can directly answer to that.
Well, according to me, that would definitely be a very good idea, because at the same time it also would mean that whenever you have some kind of public funding going into the housing sector and public provision, it should go into the production of the housing, production of cheap housing, instead of providing additional money for a household to go into the private rental sector, because that's just driving up rents. So that we have learned in the last years, and always the bad example has been Great Britain, where we've seen that only many years or decades ago. But nevertheless, there are many studies showing that overall the total public amount that has to go, money that has to go into the social security, whatever, connected to housing is much higher when you go into this so-called subjective-based things, where you provide it directly to the households. Step by step, all governments and economies are moving towards that system. So also Austria is doing that for the last years, increasing the idea that the rent should be diminished by households having an additional fraction for housing cash in their hands. That's not reducing speculation, but it's just aiming that households are richer now, so we can ask more money. And the fraction of money that is spent by versus increasing continuously
Yeah.
the last years.
Can I just play devil's advocate on this one? because actually I would hold a different opinion. I agree that we have massive problems in the housing market, and that a lot of people find it really hard to find affordable housing. But I don't think rental caps, putting it on basically private landlords, putting it on them, is going to help that much. Again, it's a lot of intervention.
Yeah,
And
I
actually,
wasn't suggesting a rental cap. I was suggesting a buffer stock of housing, so that it's
oh, okay. Oh, I
because
thought you wanted to.
that goes
Okay.
exactly in
Sure.
that direction that we are not, that we don't want.
Oh,
Yeah,
okay.
So,
Yeah,
so
yeah.
if there's a price crash, there's somewhere for people to go where they can rent from the state.
Oh, I see. Well, I think Vienna is a great, I think 40% of the overall housing in the city is publicly owned, or and that
that's
keeps
the
rent.
housing stock. But there is no new housing provision anymore. So, but nevertheless, that is always supposed to be the reason why rents, compared to other big cities, are still quite low.
Exactly.
Compared to that. But on the other hand, when we see the difference between the dynamics of the publicly owned part and the private owned part, we see that this dynamic is increasing in the privately owned part. And as we have an increase in population in Austria, and those people who are like a party of them are not really rich, and we see that also with the what everybody called migration crisis, whatever we don't call it, we just have a strong inflow of population. And those people coming are mostly those who are not very, very rich and have a high income, so they go again into that sector of the publicly owned stock, which puts a lot more pressure on that part and drags out those people who are on like lower middle income, who don't fit into the publicly owned part anymore, and then suddenly they're in the open market. And they can't afford those rents in the open market. So we should increase the publicly owned stock, or whatever kind of affordable stock, so that we don't have this social gaps in the population.
Completely agree there.
Yeah. Yeah.
I find it very interesting what you said about the housing and possible bubble speculative aspect. I would like whether you could address that. First of all, this buffer stock thing, I don't think it really works from a German perspective. You have a lot of buffer stock in the eastern part of Germany. The problem is that people where the shortages is somewhere else, right? People don't migrate just to a buffer stock and move to another city. But what of this is really a bubble? Also with respect to Germany, I see a kind of also a real resource shortage, right? A supply shortage. I know from communities that desperately create or try to create affordable housing, and they have seen prices going up by 40%, which is not necessarily speculative. It's just that the suppliers can basically, due to a shortage of manpower, call such prices. The next thing is, what do you think? So, what is speculative?
Yes.
Where do we see something with MMT, and where is it real? And isn't the communities often supporting these developments? I know of communities, due to this kind of crazy balanced budget, even on the community level, they speculate on increase in land prices. I know communities that openly say, if you talk to them, we hope to get rid of them on time, and so on and so forth. And secondly, and this is even a criticism maybe that could be addressed to the left and green left in Germany and other countries, that the artificial shortage is created by saying basically we have to land, additional landscaping cannot be, it's not affordable due to ecological reasons and so on. And doesn't that also create a real aggregate supply part problem?
There were lots of questions. I try to cover that. The first part was the bubble question part. What we see is also the Austrian central bank. So again, central bankers are doing a lot of research, as we have heard now the whole day. So they created a so-called fundamental price index on the housing sector with exactly exactly the aim, to figure out, is that already a bubble? But the bubble again means bubble for the for the financial sector. So what it is, it is not a bubble for the financial sector, because the result was that those who go into home ownership and pay those higher prices are still the richer households. So those who profit from low interest rates and have a higher income, they profit from the changes in the housing market, and they even drive up the prices. So from this perspective, we are safe, because we are not creating a bubble in the financial term. We are rather creating a social negative bubble, and that is driven by a high percentage of what you just said, that those who are supposed to provide affordable housing can hardly do that, because they are facing, on the one hand, a lot of other like legal obligations they have to fulfill, so they have to do everything. They have to do sustainable housing, or environmental sustainability, like social, and they have to are not allowed to put up whatever rent they like. It should be the cost should be covered. At the same time, the land increases. So that's exactly what you said. Those communities who are selling land are speculating on land, because they have to fulfill, again, the Growth and Stability Pact. And also the Inner Austrian Growth and Stability Pact means that they have to save even more to support the public administrative part. So they can't escape from that spiral as well. So they have to prove that they are doing whatever they can. So they sell it at a already speculative price already, and those like land parts which are still available, they are getting like diminished, or they are the outskirts. But if they're in the outskirts, they create a higher public cost again, because you need street lamps, whatever. Like, so again, the costs are transferred and transmitted to the next generations or the next years. So we have that. We experience all that in different countries, in different cities, also in throughout Austria. But the thing is that whenever you have, again, those limited profit housing organizations are the ones in Austria at the moment who have to bear all that. And if they can't do that anymore, then we are into the more German system, when we abolish that non-profit organizational structure, move towards another structure, and that means then there is no rent control, let's say, because there's even less provision housing. So what I think there have to be a huge bunch of measures have to be taken, starting already from the land costs, and who is saving that and who is speculating on that in the future. And so it's not only private households who own that land, it's also the public who owns that land. And it's a big issue also in Austria. So in Vienna.
Can I just add to that?
Yeah.
I would be curious if Steve would have another suggestion for Growth and Stability Pact, because that's essentially also doing the opposite of what.
Well, I've just actually seen from Vito Constanzo a statement that he thinks they should renegotiate the Maastricht Treaty, and have that coming out of a member of the ECB board is probably the most positive development I've seen in the European Union in the last 10 years. Whether it will lead to anything, I don't know, but it's at least it's a glimmer of hope. So, but otherwise, as you know, I'm a very strong critic of the euro. And in that case, I stand on the left-wing shoulder of Wayne Godley and the right-wing shoulder of Milton Friedman.
Right. I thought maybe you have another nice.
You recognized that Senor Constancio recently was replaced with Luis de Guindos.
Oh, that's why he's talking up. Okay.
Oh no, that's all I had to add to it. I don't like to hear it's such an oxymoron. It always like when I hear stability and growth pact and it's doing the exact opposite.
It is opposite,
yeah.
unfortunately.
Let's get into that.
Yeah.
Okay. More questions over there?
Yeah, I mean, I question your claim that macroeconomics ignores money, because the father of macroeconomics, i.e. Keynes, wrote a lot about money. I mean, his general theory was partly about money, and he gave huge role to money through liquidity preference in clogging the system up by deflating necessary demand. And he also claimed that investment was not, as you say, was not generated by savings. Au contraire, it was created by consumption or expected consumption. That's why firms invest. So that seems to me to be quite parallel, actually, with what modern monetary theory is saying, i.e. if investment is driven by savings, neither is money. They're both created by consumption. So that's one point. The other point is that claim that savings never creates money, isn't there another route by which it might, i.e. savings goes into pensions and to insurance funds, and it's the pension and insurance funds that were largely the provider of money through QE, because quantitative easing, certainly in the UK, was achieved by the central bank buying government bonds back off the pension and insurance companies in return for cash, who then rolled it on to buy back more, get more government bonds to give that money back into government use. And so the only reason the pension investment funds have got such huge funds as they have is due to savings. So isn't that another route by which actually savings might be creating money by driving the QE process through pension and investment funds?
Maybe I can answer that
Sure.
before.
No, of course you have a place to do it.
So John Maynard Keynes in his general theory writes in the introduction, monetary detail falls into the background. Okay, so it's one of the points that he makes. If you look at the treatise on money in the 2 volumes of 1930, the first 6 pages he says he's a chartalist, so he writes about NAP. But somehow in the English tradition of post-Keynesianism, all of this was forgotten. So Robert Skidelsky doesn't have even an entry on NAP or chartalism in his biography, never talks about it. So in Germany this is more known because Knapp was a German, probably. So yes, of course, John Maynard Keynes writes in the general theory, I think it's chapter 2 or 3, that basically it's not that savings create investment, but it's the other way around, so he's already got it clear. So yeah, that's a pretty good book. I agree. MMT is more, it adds more monetary detail. That's how I would put it. And of course, it expands more on the chartalist thing. Can savings create investment?
Preference is core to Keynes.
Sorry?
Liquidity preference is core to Keynes.
Yeah, but we don't. Most MMTers don't agree with that. Okay, so they see it as secondary, but we can talk about it in the break probably. It's more of a specialist discussion. But your second question about savings create investment. Well, if I give my money to some kind of investment fund, they buy an existing asset. Okay, that will not lead to investment. It leads to financial investment, but when we talk about macroeconomics, by investment we mean investment in capital assets, in physical assets, like building a house. So this means we have this post-Keynesian idea that you have initial finance, you have final finance. So once you want to build a house, you get a loan from the bank, and then somebody might buy that loan, which is then securitized. But the second person buying the securitized loan is not creating investment, even though that person is saving. Okay, so we make this distinction, which I think is very useful to understand that one is about the portfolio allocation in the Tobin kind of sense, and the other one is basically the financing of the actual investment matter. So that, of course, is not a portfolio discussion. So in the portfolio sense, most MMTers would agree with Tobin and the liquidity preference, but they would not say that the interest rate is driven by liquidity preference, which seems to be implied somehow in Keynes. If you read chapter 17, it's always wobbling that there's yield and interest rate, and there's no capital gain. So Minsky has it more clear, but again, we can talk in the break. Did I leave anything to you? I don't know.
No, I like very much what you said about Keynes. Maybe just to add to that question on post-Keynesianism versus MMT, and I think a lot of people here are a better place to talk about that. But from what I heard from some post-Keynesian guys is like, okay, we've been saying this for 50 years, so, Basil Moore, and then MMT came around, which is basically just putting a sexy label on something that post-Keynesians have been saying for a long time. So I don't think there's such a dichotomy, but I mean, we can maybe have that discussion over lunch, or you want to add to that on the second part, pension and insurers. I mean, most pension funds don't have a banking license, so you can only create money with a banking. That's what you need. You need a banking license. So if you have a pension fund who collects your deposits and buys existing bonds, no money being created. If it's a bank that does it, then yes, money is being created, but again, the money creation precedes the savings, the creation of savings and deposits.
Maybe
just very briefly, for me, it always means that endogenous money is in the center, and the interpretations of the functioning and the further implementations of endogenous money might vary across those different structures, if it's called modern monetary theory or whether on a structuralist approach of post-Keynesianism. But in the end, we all agree that it's endogenously driven, and there's a strong distinction to the new macro approach of new Keynesianism when they call it endogenously driven. It might vary a lot. I think somehow agree. And yeah, and of course I think that when what you mentioned, the discussion about the importance of financial sectors and what kind of finance they create, which we not say as investment, but for financial assets in terms of financialization, which is driving up, might then even get a new shape when we talk about the digitalization of the financial sector. Because now when we create new ideas of not banks having that shadow banking being more important, this is, I think, so far also not covered in monetary theory. So I think that it would be then in the end be maybe called new modern monetary DG or something like that. Because I think that's the next stage.
Actually, this is Minsky's money manager capitalism, which was before shadow banking.
Yeah.
So shadow banking reinvented the wheel, not MMT, which will have to reinvent the wheel. So maybe we can give the last question or comment to Andrea.
May I try to answer the question about how to reform this Stability and Growth Pact? I think there's no need to reform this Stability and Growth Pact. I think what we need is a fiscal coordination above the Growth and Stability Pact. And my message was that the government of money is a political issue, so there's no monetary or financial reason that make it impossible to implement solutions such as, well, for example, your BBOV has a proposal for the Euro Treasury, which is workable. But one could think of the ECB keeping the public debt that has been purchased with the asset purchase program forever, and replace it with certificates of deposits, and remove this public debt on a equal share for all countries from the debt GDP ratio that counts into the Growth and Stability Pact. Or you can imagine a 50% cut in the VAT of all countries funded by the ECB. Who else can fund it? Everything is funded by the ECB, as I tried to show. So nothing strange. It's only a political issue.
Okay, I think that's a very nice last words for this session. So thank you for attending, and I'll see you again here at 2 o'clock sharp.
Lots of overlap with Oh, Louis Philippe. Oh, really? You didn't invite you. Market operations at ECB, there's some nice paper saying that negative equity doesn't matter. But it's very important. Which
Ja, aber der organic
Actually, that's something maybe right now to
At the end of the day, if I'm unemployed in Brazil, I get unemployed benefit, I get 1,000 euros. If I'm something like that, I get another money. So if it's a money return,
yeah, so he actually
then what you get, then you have capital, you own your house, and you have
last year. Still has a lot of flaws, but he put he put which is still flaws. But it's
Ja, bei dem nächsten Teil
so
hast du halt zwei Untersuchungen.
Deswegen
Deswegen der Dr. Sommer kommt von der Bundesbank mit dem
MMT
Geld.
and youth unemployment.
and
Da macht er quasi eine Art, da können die Leute halt mal
Therefore,
das ist die beste.
Online work file.
forget it.
He always agrees with anything I say.
Really? Yeah. He always agrees with that? That's great.
No, sorry, ich bin Alexander Leifel. No. Well, yes, actually, I have one. Yeah, I remember. This is had to get sure that I have got
selber nie ausprobiert, ich weiß nicht, wie das ist, aber ich meine, so sexual balance ist quite
It's quite amazing. At least they break
okay, sure, yeah. SFC Modeling, wirst du ganz viel finden, Standard, im Sommer jetzt aber wieder Ausschreibung für Postgraduate gut ist hier in Berlin. School, 2 Wochen, die auch ganz cool, die so am See gelegen. Aber das
Sure, sure. Oh, okay. Do you also want to go for lunch or? Yes.
So you work for the government of Germany now?
I work for the IMF right now, but I'm an advisor to the German director.
I have many questions.
Okay.
Shall I go? Yeah.
Erik Jochen, who's here, and Alex Hoffman, who's not here, and then me. So we got.
I've got to go back to getting a plane at 6 because I've just been travelling too much. I'm travelling again next week with this guy.
Had the same idea, basically saying, look, we want to educate the public because so many things that happen that normal people just don't understand, and that's not good. Not good for democracy, not good for the public purpose, not good for the well-being of people. They feel left out because they don't understand what's going on. And You can see that basically, well, 10 or now 11 years almost after the Lehman Brothers collapse, there's a lot of political backlash now. So we try to help enlighten the public and transfer knowledge from the science sphere to the public sphere. So this is basically the goal that we have as Prüfung of Gesellschaft. And we are using basically MMT, this approach of modern monetary theory, as the approach to teach people how things do work. Prüfung of Gesellschaft now has about a dozen members. If you want to become a member, it's also possible to fill out the form here. We have 60 euros per year as the monthly, the yearly contribution. Not yet. And for students, we have a special money. We know that you cannot create your own money, or if you do create your own money, we will not accept it.
All the material you need to understand them up to the second order anomaly and actually very nice piece of writing.
For now. What is MMT then?